If you've looked at the Indian market recently, you've felt the massive momentum. Investors are aggressively bidding up high-growth assets, chasing a relentless bull run. This chart shows the steep, uninterrupted upward curve of BSE Limited stock, completely detached from gravity. In just 8 weeks, the share price gained nearly 62. To figure out if paying that premium makes sense, we have to break down BSE's exact financial anatomy. We need to look under the hood and decide, are you buying a generational wealth compounder, or are you stepping into a late-stage valuation trap? We start with the engine. The Bombay Stock Exchange is Asia's oldest physical exchange, but it has completely rebuilt itself into a digital infrastructure powerhouse. Their smartest strategic move was a pivot in how they charge for derivatives. Instead of taking fees based on the massive notional value of a trade, they charge based on the options premium. This heavily insulates their revenue, meaning even if trading volumes compress, their fee structure protects their downside. This pie chart shows how that strategy played out in FY26, driving total revenue up 59% to 5,148 crore. Look at the breakdown. Up to 60. Another 18% flows from high-margin co-location services for algorithmic traders, and 12% is fed by their Star MF mutual fund platform. But a highly efficient engine running at maximum capacity generates a lot of heat. BSE's success is heavily concentrated in one specific, highly volatile area, the retail derivatives market. That concentration draws attention. SEBI is preparing strict regulatory crackdowns, specifically targeting retail F&O trading volumes to curb market speculation. So the engine is a double-edged sword. It is incredibly profitable right now, but it is dangerously exposed to incoming rules from a single regulator. Let's look at what that engine produces. In the last financial year, BSE's profit after tax surged 88% year-over-year, hitting 2,497 crore. That profit translates to two elite efficiency metrics, a 58% return on capital employed and a 45% return on equity. A 45% ROE means every dollar of equity generates 45 cents of profit. But as the company retains massive profits, its equity base grows. Even with exact same profits next year, dividing by a larger base means the ratio will inevitably drop. This is where momentum investors often make a mistake. They see a high-flying percentage metric start to normalize, and they panic, assuming the business is failing when it's experiencing the math of scaling up. BSE's current capital efficiency is historically elite, but if you are modeling your returns, you must factor in a mathematical cooldown in those percentages over the next few years. Underneath those returns is a balance sheet with zero operational debt and absolutely 0% promoter pledging. This diagram shows why traditional health metrics don't apply here. A normal factory has millions tied up in physical inventory and delayed invoices. BSE operates a digital toll bridge. They have no physical products to store, and they collect their transaction and listing fees entirely upfront. The result of having zero inventory and instant payments is a high cash conversion rate. That structure has allowed BSE to stockpile a massive 90 billion rupee net cash reserve. Management rewards shareholders directly from that reserve, maintaining a healthy 22% dividend payout ratio. But holding billions in cash during a high inflation environment comes with a cost. Management faces constant pressure to deploy that money effectively, either by acquiring prime real estate for expansion or aggressively upgrading their tech infrastructure. The balance sheet gives them bulletproof safety. The trade-off is that if their digital platform ever loses market share, they don't have hard physical assets or machinery they can liquidate to recover your investment. That brings us to the cost of entry. Right now, the market values BSE at an enterprise value to EBITDA multiple of nearly 53. At 69 times trailing earnings, the market is completely pricing in the projected 25 to 26% compounded annual growth rate all the way through 2028. You are paying for perfection. This chart shows the extended valuation. The P/E ratio peaks on the far right, above historical medians. When growth slows, we see multiple contraction. The multiple shrinks back to the historical average, and the drop is violent. If that contraction happens, BSE's actual real-world earnings could continue to grow perfectly, but your portfolio value could remain flat or even negative for years while the multiple resets. You are paying full retail price for 5 years of flawless execution. There is simply no room for error built into the price. Management knows they have to justify that price. Their 5-year strategy relies on maintaining their 6-microsecond trade latency, exploring a 24/7 crypto-style trading model, and integrating AI into market surveillance. But there is a massive existential shadow hanging over those plans: the upcoming initial public offering of the National Stock Exchange. The size disparity is stark. NSE generates roughly 3 times the revenue of BSE and holds a deeply entrenched monopoly over the cash market. When NSE goes public, it triggers a mechanism called institutional rebalancing. Massive domestic and foreign funds operate with strict fixed percentage allocations for the exchange sector. Because they can't simply exceed their sector limits, these massive funds will be forced to sell off portions of their BSE holdings just to free up the cash needed to buy into the newly listed NSE. This means BSE faces a high probability of a short-term valuation depression, and it will be driven entirely by institutional portfolio rotation, completely separate from the strength of BSE's own balance sheet. So how do you handle a great company at a difficult price? Professional analysts currently place the aggressive bull target at 4,800 rupees and see the accumulation support level down at 3,500. Let's map your decision. This matrix shows who should avoid the stock completely. If you are a deep value investor who requires a low price-to-earnings growth ratio, stay away. The 69x multiple, combined with the high risk of SEBI regulatory action, breaks every traditional value investing rule. Avoiding the stock preserves capital, but you miss out on compounding growth. If you already own it, you belong in the hold category. Ride the elite 45% return on equity and collect the 22% dividend. But holding requires stomaching volatility from semi-headlines and the NSE IPO. Finally, the buy category. Long-term investors looking for a wide moat should target the stock strictly on dips. Wait for market panic to push the price into the 3,500 rupee accumulation zone. The strategic trade-off here is simple. You must be willing to endure near-term multiple compression in exchange for the long-term compounding power of the exchange. BSE Limited is a high-performance financial engine, but at 69 times earnings, success depends on the patience to wait for a better entry price.